What's going on, guys? Welcome back to Let It Grow Investing. I'm Jeff. I just did this episode and now I've got to re-record it because for some reason it didn't want to record. So hopefully this one is not all wasted. So we're going to get right to it. I already did it once. We're going to do it again. But here we go. We've got a lot of different things popping off in the market, a lot of different things that we want to catch up on. I'm going to try to keep it short and sweet. Let's roll right into things. Let us go ahead and share what is going on with Google stock. Let's pull this one up. We got Google stock jumping 8% after search giant avoids worst case penalties in antitrust case. Right. So we've got a federal judge ruled that Google can keep its Chrome browser. So this was another thing that was dragging, Alphabet stock down, was the fact that we didn't know what was going to happen with this antitrust case. Google can still sell or pay Apple billions a year to be the default search engine on iPhones. So that is huge for Apple as well. They're getting paid to do what basically they were already doing. So we've got, Google benefiting about 8%, Apple benefiting about 4%. The market was down a little bit on Friday, but a lot of solid moves for some of our favorite names. So if I do go up and pull up the E-Trade account here, let's go ahead and pull up the S&P 500. We're going to go ahead and share this tab instead. Oh, that's a 5-year chart. We're looking at almost a double over that 5 years compared to another stock we're going to look at later. We've got a 5-day chart that is trending higher, right? We were looking at Monday, a low of around 63.60, and by the end of the week, 64.81, with a peak out at 65.31. We're looking at. The S&P has been performing pretty well. Why did we drop on Friday with all this good news coming out? That was to do with jobs, right? We were looking at the jobs report. It's one of these tabs up here. Where are we? Here we are. Let us look here. We've got some of these numbers getting revised higher. We're looking at the July numbers being 73,000. That was revised higher to 79,000. But June's data was more negative. 13,000 jobs were lost during the month, a first outright monthly decline since 2020. Revisions in early August have brought June's job growth down to 14,000. So again, some changes there. Right now we're looking at August numbers. We were looking for 75,000 jobs to be added in August. We only got 22,000 jobs. So a substantial miss on that front. Unemployment up to 4.3%. So what does that mean? Well, when we are looking at what the Fed's going to do, we are looking at this, the CME FedWatch tool. We are currently at a rate of 425 to 450. You might be able to barely see it at the top there. We're looking at the September meeting going down potentially 25 basis points. About 89% of economists are saying we're going down 25 basis points. About 11% saying we're going to get a 50 basis point cut. So we're curious to see what these numbers mean, where we're going to go from here, and who's going to benefit, right? So there's a lot of different things at stake here. We've got uncertainty in the labor market. We don't really know what the Fed is going to do, if this 89 or if this 25 basis point move is going to do enough to spur economic activity, if we're going to get a lot more hiring because we drop 25 basis points, or if perhaps we really need to go 50 basis points at this time. So uncertainty means more volatility in the market, and that's what we got on Friday after these numbers came out. We did have some different stocks doing well this week. I did want to kind of bring that up. We had, like I said, Google did well. Other stocks that we follow, who did really well this week? That is a great question. Eli Lilly did okay. We had some different smaller names do okay. We had United Therapeutics do fantastic on a approval that they received from the FDA that basically said a drug that was already in production could be used for more uses. So we saw this one go from last Friday. If we look at the 1 month, this was going to be like the 29th. We were looking at being around 304. We shot up to around 437, and then we kind of settled back down to the 400 range, right? That's where we've been a little bit now. Still, PE at a 14.8, very cheap. We still have upside when it comes to analyst research. Some new price targets coming in the 500 range. We got Oppenheimer at 575, HC Wainwright at 500, UBS at 560, just straight out buys from Leerink and JP Morgan. We got some good news here on United Therapeutics on that FDA approval. We've got, did DraftKings do okay? I think DraftKings with sports coming back in, I still think that is a fairly solid play. I do have some covered calls there, but I do think that we could definitely see this 55 number. A lot of growth here in the recent quarter. They didn't do as much spending as far as recruiting new customers. So hopefully in this next quarter, we're going to start seeing a little bit more spurred activity. They're going to be going after more customers. Granted, they're going to be acquiring customers at an expensive cost, giving out those free bets and other things that they do in order to get people on the platform. I still believe that more and more states are going to adopt sports betting. So that is going to be another driver of growth here for something like a DraftKings as, fall sports and football kind of returns. We've definitely got a lot more activity out there. I'm still looking at some weakness, though, right? I'm still looking at healthcare stocks being ones that have been very difficult to play. And we've been looking at software stocks that have been difficult to play. So like which one was I bringing up? Adobe was one of them. Adobe is one that, over the past 5 years, it says 36% upside there. But if we look at it over the past 5 years, compared to the S&P 500, where I showed you that we were pretty much doubled, you'll see this chart. We were around 476 in September of 2020. And now we're lower, right? We are lower. So we're at 348. And that doesn't even show on here. That number is very skewed on this chart. I don't really like where that is. So maybe I'll just pull up the snapshot. We'll see if we can get a better view, more accurate without that. So 5 year, we can see on this 478. That was on 9/21 of 20. And yeah, this one looks more accurate at 348.97 now. So definitely a case where it hasn't really been doing well, right? Software as a service has had a lot of different things being hiccups to it, from work from home. Some of those things worked really well, and then people didn't really use it as much when they went back to the office. So maybe the enterprises were buying it, but it wasn't simply everyone having it on their computer or paying the subscriptions, or people were going away from it. They had different things that they were using, whether it be Microsoft Teams or Google Sheets or whatever else, right? There was a lot of different things that were at play that really weren't driving as much software. There was a lot of push to hardware. There was a lot of different things going on, right? So, we're looking at these stocks and saying, hey, Adobe looks really cheap. There's a lot of creators. There's a lot of people using it, but now there's a lot of competition, right? So now we have a lot of AI programs that can do pretty much the same at a fraction of the cost or free. And, you don't have to spend as much time using like a chat GPT versus like a Photoshop, right? So there's going to be some change there. So Adobe, I was in it. I got out of it. I got back in. I got back out of it. I was trying to see if we could get decent footing, but it never really wanted to take off. So that brings me to one of the ones that I did start a new position in this week, and that is Salesforce. Salesforce, why? Well, they got a lot of different things going for them. They did just have a solid earnings report, right? They did trade down on this earnings from a conservative guide. Mark Benioff, the CEO, has basically came out and said, hey, it's a conservative number. I think we're going to beat it, but I'm setting us up for a win, more or less, right? Could be a slam dunk. I listened to him on Mad Money. I did a little bit more diving. I'm looking at some of the numbers, some of the growth, some of the margin, the debt to equity, they have very little debt. They have great free cash flow. The margins are improving. There's a lot of different parts of this business that I really do like. And again, a stock that hasn't really done anything for about 5 years. And this is the whole group. There's a couple that stand out that have done a little bit more. They're in kind of different specialty areas. But Salesforce is adopting more in the way of AI, right? They're doing Agent Force. They're doing a lot of different things to have a lot more interaction with customers. Instead of just one-way emails to, hey, do this from Salesforce, you're getting an interactive agent on those emails. So now I think they were sending out like 11 trillion emails or something a year. Now it's even going to be higher, right? So they're going to have more interaction. They're getting more customers. They're acquiring different businesses that they're going to strip out the expensive parts and make those businesses work for them. There's a lot of different growth factors that I think Salesforce is doing well. You kind of couple that with the fact that some of these, you can see my small position here. I bought 5 shares on Friday. I was trying to see if it would come down from this 3% gain. I was trying to buy it around 247. Eventually, I just hit buy. I think I started the day at like 246, bumped it up to 248.50, and it just kind of kept going. I was like, you know what? I'm just going to buy some, and we're going to see what it does on Monday. So we'll go ahead and buy some more of that. That is definitely something I want to add to. So when I'm looking at Reuters report or Refinitiv report, whatever report you want to call this, we're looking at a stock that really has not returned for 4 or 5 years, minus 4%. We are looking at a company that is got 38% upside. We are looking at a company that has growing earnings and growing revenues, right? So 9% for 26, 18.5% by 27, but it is also trading at a discount. So if we're looking at the forward PE, it is trading at a 48% discount to where they historically trade. So, the price is not reflective of the actual earnings that they are posting up, regardless of what the market thinks, right? We are, having it sell off 6% or whatever over the fact of, the market thinking that this is going to continue going down when truthfully it was a very conservative guide. So I don't really think that the problems are really there. I think that we're in a conservative space and we're guiding appropriately. And I think we're going to beat that. So while some people see slowing numbers and they are lower than what they used to be, I still see a stock that has a lot of growth levers. They have fantastic free cash flow. They are buying and merging or acquiring companies that they need to buy. Some of them in the past have been expensive. They have been kind of penalized for that. We've seen that before, but now they are, trying to get back to a point of, growth at a reasonable cost. So price to sales, it's higher. The 5-year average is a 7.8. So we are trading underneath of that, above the S&P and above other IT companies. So that could be potentially a problem. It could be a multiple correction if something slows down on that growth front. However, the PEG ratio is very cheap, trading under where the S&P 500 index average generally trades, and way under their own 5-year average. So a reasonable entry point at a discounted forward PE ratio, right? So we're looking at a 20.9. I think this thing could trade at some of those lower growth rates in like the 30 to 32 type multiple, which would take us up substantially from here. If we're looking at an average of around 11.3, let's multiply this out. Let's see what the numbers actually look like. So 11.3 times, call it 29. That puts us around 327 as a price per share. So we're at 244, going up to 327. Maybe, if we hit that 40 type multiple, which I don't really think we're going to, that would take us up to 452. I think that's a pipe dream at this point because I don't think we have the growth that we used to have. But I think 28 to 32 is more reasonable of a multiple on something like a Salesforce versus the 20 that we're currently sitting at. So I'm looking at that. I'm looking at the growth, the margin expansion, a lot of different things that make sense to me. Agent force, leaning into AI, dealing with their customers better, acquiring a little bit smarter. A couple different things here from ChatGPT that I did look up. So we've got full year growth target 8%. We've got share buyback. This was also another thing, right? Increased by another 20 billion. So they're in there buying. They are looking to have a total of $50 billion of stock repurchases that is currently authorized. They beat on EPS. We beat on revenue. We are up year over year on CRPO bookings. We are up on, the 4-year revenue growth target, about 8%. That's reaffirmed, which was not necessarily enough for everyone. That was, they were looking for more. Solid earnings, stock dropped 6 to 8% due to a cautious Q3 forecast. Some would say it's a conservative forecast, maybe not cautious. Revenue guidance, flat to modest. EPS guidance, lower than what it was expected. Adjusted EPS, I think that was adjusted down as well. So down roughly 30% from their peak. I think that this is a little bit overblown at this point. I guess the next earnings report is going to tell us what the actual numbers are, and we'll know if we're right then. Going off of what they are saying and what the CEO has said in interviews, I do believe that things are brighter than maybe what they appeared on paper and how that the verbiage came off in the press conference. So a lot of different things to take into consideration. A weaker than expected whole software industry. This one is doing a lot of things right. They're growing in a lot of key places. They have a lot of enterprise software already there. They're growing their basis to sell more product to the people that they already have as customers, right? So they're going to potentially be able to pay off that $8 billion acquisition in maybe 5 to 6 years based on the numbers that they're currently doing. So Agent Force gaining traction rapidly. 3,000 paying customers in 90 days. Data and Cloud AI ARR was up. This is crossed out. I'm not too sure why. Shares fall on weak sales outlook amid AI agent push. Q4 operating cash flow 13.1 billion, free cash flow per share of 160 annually. I don't know why this is redacted, but it is. Impressive margin expansion. Said that operating margins around 19 to 20%. Non-GAAP margins above 30%. That's pretty awesome. And I think that's supposed to continue to expand. Flexible, expansive ecosystem offers customizable modules across sales, marketing, service, analytics, plus robust integrations and app exchange offerings. Yes, they do have drawbacks, right? Growth leveling. We talked about that. They aren't growing at the same rates that they used to be. Q3 guidance disappointed investors and triggered stock weakness. I think it's overdone. That's part of the reason I'm buying it. Part of the reason, other reason was, that really low PE number. I think there's a fair amount of upside. I think there is very limited downside. Should we see the S&P, correct 15 to 20%? Yeah, this thing could get down into the 100s. It could potentially hit like 180, 190. But I don't necessarily see that happening. Could we get some little pullbacks along the way? Yeah, we will. Is it going to, crater 20% tomorrow? I mean, I suppose it could. I'm not really counting on that, but, that's kind of worst case scenario, which in that case, I'll find a way to buy some more of it. We got free cash flow was good. The debt to equity was really good. I think their debt was only around 33% of their cash and marketable securities that they currently have. So a lot of different things going well for Salesforce. I think software could kind of make a comeback, similar to what Google did. A lot of people saying that Google search wasn't going to continue. A lot of people saying there's a lot of drawbacks, a lot of anchors in the sand for what Google could be. I think that's kind of where Salesforce and a lot of these other software as a service companies are currently. So I think we start getting away from some of those. We start seeing some new highs, or maybe not even new highs, but we start getting into maybe not all-time highs, but maybe in the yearly highs. We start to see some of those kind of break out. Cautiously optimistic here. I think it was a conservative read. I like what they're doing. I like that they're leaning into AI. They're not really just selling a repackaged chat GPT. They're kind of going after Palantir in a lot of ways. They're trying to, get into a lot of those spaces that Palantir's already in with the customers that they already have. So I think they're really looking to expand. I think they're doing it fairly safely. And, I'm thinking that this could be a good long-term purchase. Maybe not the quickest turnaround, maybe not an overnight double, but I think by 2030, we could start to see this thing get, 70, 80% higher than currently where we are. So that's what I'm doing with this one. Now, what do I want to buy for the investing challenge for this week? I already, I've ran through this whole thing already. The stocks that are on this cheat sheet to my left, NVIDIA, Tesla, Meta, Amazon, Eli Lilly, in Next Era, NEE, CrowdStrike, CRWD, Costco, Bank of America, AMD, and IBIT, which is Bitcoin ETF. I mean, I've already ran through it. I already know what I'm going to say. I do think I like Salesforce when it comes to a lot of different things. If I was going to cheat and go away from the list, I mean, you look at this and you're saying, yeah, 31% here. The Refinitiv said 38%. The growth is decent. The PE is decent. But if I'm not cheating and if I'm going off of the 12 or 13 pre-selected stocks, where do I want to be? Eli Lilly, man, I still really like Eli Lilly stock. 25.5% higher. Tesla's pretty flat, but I think they could be doing some things behind the surface. Amazon, did I get into Amazon in this one? I don't even know if I covered Amazon. I don't think I did. Let's talk Amazon real quick. Partnering with Anthropic, which they've been doing for a while. We had AWS currently building 3 data center campuses for Anthropic, total 1.3 gigawatts of capacity. These centers are expected to primarily utilize Amazon's Trainium chips. Can't read. Amazon's data centers will hold the largest cluster of non-NVIDIA AI chips with nearly 1 million Trainium 2 chips in its biggest campus. So the Amazon chips are not as strong as the NVIDIA chips, but Anthropic was involved in the design process, meaning these chips deliver specifically what Anthropic needs to run its large language models. So is Amazon going to sell these other places? Likely. Are they as strong as NVIDIA's? No. So we've got potentially, if you're looking to have the strongest chips, you're probably still leaning towards NVIDIA. If NVIDIA can continue selling H20 chips and not have a lot of the business taken by Alibaba or any other Chinese type company in China, I still think that is a major driver of growth going forward. I believe Jensen Huang said around $50 billion of sales potential to China. I believe that was in the number. Don't quote me. I could be wrong, and that could have been on a different timeline as well. I know there's big potential there, though. Is this a huge detriment to NVIDIA? It is a risk. I think that Amazon is a fantastic company. I don't know that they have the upside that NVIDIA might have right now. Around 13.7% when it comes to Amazon. I'm down here. NVIDIA, after a bit of a pullback, while Amazon's on a run after some of this announcement, got around 26% for NVIDIA. Oh man, I think if we were going to buy NVIDIA, I like this entry point more than where we were, a month ago, right? We've come down around 20 points. It makes a little bit more sense. The PE is still stretched. The PEG ratio is really low. It's like at a 0.9. The price of sales was above. I think it was at like 25 times price of sales against a 5-year average around 19. Again, don't quote me. I'm just going off of what I said earlier. Man, I still really like NVIDIA. I really like Amazon too, but I don't know. I'm not as itching to buy it at this point in time. CrowdStrike didn't make as much sense. Next Era, we just purchased. Costco. If jobs keep kind of cutting back and we don't really have the growth there, potentially that could make more sense. Around 13% upside on Costco. I don't know. I still think I think that NVIDIA is going to get my money this week as far as the investing challenge goes. And then for my own brokerage account, I am going to be buying some Salesforce. I think it is worth the risk at this point in time. So more upside, definitely undervalued in my opinion. Now, does it shoot back quickly? That's the $1 million question. But I don't know that I'm buying this for a quick turn. I think I'm buying it for maybe a 3 to 5 year play, right? I think that's where I'm kind of at with Salesforce. So I did have a buddy who's a 7 or 8 figure investor asking me, hey, where should I park some money right now? And it's always such a tricky question. It really depends on what you want the money to do. Do you want it to 10x? Do you want it to be safe? Do you want it to be a 5-year play? Do you want it to be a 1-month play? Do you want dividends? Do you not? Do you care about the risk? Do you care about anything else? So I said Salesforce seems like a good entry right now. There's a lot of other stocks out there that are going to outperform it in the near term, potentially, right? I think that there's a lot of risk in some of these other stocks that could potentially throw up a 3x number in the next 2 years. Salesforce isn't going to be that, right? I don't expect them to be that. I'm not counting on them to be that. I think this could be a double by 2030. I think that's where I'm roughly at, right? If we start to see 12, 13% revenue kind of growth year over year, I think that's kind of a realistic number. Now, could it potentially go under that? Yeah, I mean, certainly. I think base case, you're probably 10% cheaper than that, probably somewhere in the low to mid 4s. And I mean, base case, I mean, I would shoot to say 350. So I mean, I'm saying over like 5 years. I'm not saying that it's going to go to 330 in a year. I don't know that it's going to do that. But I think if we zoom out and we take a look at this thing in like 5 years, we could potentially double. So one, I think it's a decent entry. Two, I think it's kind of being slept on with a lot of software stocks, with a lot of healthcare stocks. So that's a lot of the reasons I'm getting into Salesforce right now. That's what I got, guys. I mean, I'm going to go ahead and buy NVIDIA for the investing challenge, but I'm going to continue adding some CRM to my own brokerage account, more than the 5 shares that I showed you earlier. So that's what I've got going on. I'll probably take it to like maybe a 1.5 to 2% of my portfolio. So I don't know, maybe 15K, 20K type position, and maybe less. We'll see. We'll see how much money I want to commit to this thing and really where it goes from here. So that's what I've got for you guys for this week. Thank you guys very much. Please make sure you like, subscribe, and share. It does help really grow the portfolio, the podcast. Hopefully we can grow the portfolio too. That'd be awesome. So I would definitely appreciate it. But yeah, thanks for stopping by. I will catch you guys in the next one. Take care.